Hi team, in this video we're going to look at the terms of trade. So similar to previous videos, we want to understand what it means and how we measure it, and then we want to look at the factors that impact it. In this case there's only two that you need to know, and then finally we're going to look at the effects of movements on the terms of trade on our goals and living standards. So before we dive in, we needed to get a sense of what the terms of trade is. So let's zoom out for a moment, and basically the terms of trade refers to the ratio of the average price of a country's exports to the average price of its imports over a specific time period. So think about it. What is the average price for all our exports versus what is the average price for all our imports? And what does that mean for net inflows and leakages from our economy? So in essence, this is trying to measure our purchasing power, where we want to see improvements in the terms of trade over time. So an improvement in the terms of trade means that the prices that we receive for our exports is increasing relative to the prices that we pay for our imports. So an improvement is a positive thing in the sense that we should be receiving a greater price relative to the price that we pay for our imports, which suggests improvements in our purchasing power. So improvements result in an increase in purchasing power and economic benefit for our country, as it can buy more imports with the same quantity of exports. All right. So put simply, guys, it's all about purchasing power here. Basically, we want the prices of our exports to be growing or at the same level as the increase in the price of imports, if not growing faster, such that our purchasing power on the international stage is getting better. So this is your equation, nice and simple: an index of export prices divided by an index of import prices. That index is attempting to capture a single number that in essence represents all the prices for our imports and all the prices for our exports. So you can imagine that's fraught with issues, but it's the best we've got. We times it by 100 and that gives us a number. So let's use this data to try and make sense of what that means. You can see here in year one, we've got an index of export prices and import prices, both equal to 100. And so if we apply the equation from the previous slide, 100 on 100 times 100 is equal to 100. Now, on its own, that number doesn't mean much. It does tell me that for every dollar that is spent on an import, it is reciprocated by a dollar that is received for an export. Okay, so we're breaking even as such. Then if we look at the numbers from the second year, we see that the index of export prices falls to 96 and the index of import prices rises to 120. So without doing the maths, this doesn't look great. We're receiving lower numbers for our exports and now we're paying more for our imports. But let's prove it to ourselves. If we put it through the equation, 96 on 120 times 100, that gives us 80. Now, once again, 80 on its own doesn't mean much. On its own, it does tell us that for every dollar in imports that we are spending, we are only receiving 80 cents back in our exports, which doesn't look great. But then if we compare year one to year two, we can see that the terms of trade has fallen from 100 to 80. And so that basically tells us that our purchasing power is deteriorating. So if we go through the answers, we can see between year one and year two, the terms of trade has deteriorated. So the answer has to be B. And like I said before, in year two, for every dollar spent on imports, 80 cents was received from exports, which indicates a decrease in Australia's purchasing power relative to year one. So that would be a red flag, okay? As a country, we would look at that and go, okay, something's wrong here. Our export prices, why are they falling? Is it because of a lack of demand? How come that's changed? How come the price of imports has increased so much? Is it tied to the exchange rate? It starts to sort of beckon those questions. So here is Australia's terms of trade since January 2019, and you can see that, yeah, it fluctuates, it's up and down. Obviously, we're generally more concerned in the last couple of years, so if we were to analyse this from, say, July 2021, we can see that deterioration in the terms of trade over that period, which suggests that we are either receiving lower prices for the exports that we sell, or we are paying higher prices for the imports that we buy. One of those two, or a combination of both, is occurring, and that is negatively impacting Australia's purchasing power, which we can then go on to conclude, well, that's going to limit our access to international goods and services. Therefore, we can say there's going to be a decrease in material living standards for the average Australian based on this. So we need to understand what are the factors that influence the terms of trade. There's only two of them that you need to look at. The first one is commodity prices. And for Australia, commodity prices is so important because commodities make up the bulk of our exports. So this is tied to the index of export prices and why that might change. So a general decline in Australia's commodity prices over the past 2 years is obviously going to be unfavourable for the terms of trade. So the numerator, the index for export prices is going to fall. That's going to cause our terms of trade to decrease. And if we have a look here on the right at this graph and we sort of analyse the last 2 years, we can see that sharp decline that we've experienced, call it since maybe the end of 2020. So we did reach some highs up here in the sense that we didn't obviously get to 120, but we almost got there. And then we see a sharp decline down to almost 80. So that is indicating to us that our export prices for our commodities is falling and that that's going to funnel through to a negative impact on our terms of trade. And just to put that into context, if our export prices for our commodities are falling, why is that such a bad thing? Well, have a look at the level of exports that Australia obviously sells to the world. You can see the majority of them are steeped in commodities. We've got coal briquettes, iron ore, petroleum, gas. These sort of dark red ones here make up the bulk of our export industry. Even gold at 4.2 stands out as a massive number. There are other exports in here that don't relate specifically to mineral commodities, but in essence, if Australia is suffering from a decrease in the price of its commodities, our export prices are going to get hit, and that is going to lead to an unfavourable impact to the terms of trade. The other factor that you need to know is the production costs in our trading partners, and this one is levelled exclusively at the index for import prices. So this is talking about the denominator for the terms of trade equation. So basically, if there is an increase in the cost of production from our trading partners, it would make sense that they would pass that on in the form of higher prices to their customers. If we are a customer for an international producer, well, then we're going to get hit with those higher prices. That's going to funnel through to an increase in the index for import prices, and that ultimately is going to reduce the terms of trade for Australia. The opposite is true. If there's a decrease in the cost of production for our trading partners, then we're going to benefit in the form of lower import prices, and that's going to funnel through to an improvement in the terms of trade. So what you've got here, guys, is two factors where one factor impacts one part of the equation and the other factor impacts the other part of the equation. So it's really important that when you speak to these factors that you isolate the aspect of the equation that's hit. Okay, the final part of this video is we need to understand how changes in the terms of trade impact our goals, our living standards, and I'll make comment to the current account as well. So again, coming back to the equation, right? Anything that hits this equation is obviously going to upset our terms of trade. Note that it's built on exports and imports. I hope I know you know where I'm going with this. So we can start to think about the terms of trade as an aggregate demand side factor. We can think of it as an aggregate demand side factor because it brings into it exports and imports as well. But I'm going to speak to exports for this exercise. So if there's an increase in the terms of trade, it generally is going to occur because there's an increase in export prices or a decrease in import prices. So let's assume there's an increase in the terms of trade, and that generally implies that Australia is enjoying strong demand and receiving higher prices for exports. So let's stick to the numerator for a moment and assume that that improvement in the terms of trade is because of an increase in the index of export prices. So if that's the case, that is likely going to be fueled by an increase in the demand for exports, right? So let's just wind it back a second. There's an increase in the demand for exports. There's going to be an increase in export prices, which is going to funnel through to improvements in the terms of trade. So if we draw it back to the cause of the increase in the terms of trade, it's because of that increase in export prices. And so if you can isolate the increase in X, well, then you can funnel it through to the increase in aggregate demand, and you can shift the curve to the right, and then you can speak to the axes. So in this case, we have an increase in inflation, we have an increase in economic growth, which means we have a decrease in unemployment. They're your three avenues with which you can then speak to one of the three macroeconomic goals. Okay. The other part here too is that if we're talking about export industries enjoying higher prices for their products, those industries are also going to be enjoying higher profits. And so if you're a mining company and you enjoy higher profits, you're likely to reinvest those funds back into your operation in order to expand and obviously become stronger from an economic perspective. And so I haven't got it on the slide, but the other part here is you can funnel that through to an increase in investment spending. And once again, an increase in I is going to lead to all the same outcomes here. So just another avenue. The opposite is true. So basically we're saying if we're going to suffer weaker demand for our exports, which would funnel through to lower prices, which would damage the terms of trade, well, that decrease in X is going to lead to the decrease in AD, and then basically all the opposite outcomes are observable on the graph, and then you can speak to those within your links to the macroeconomic goals. The current account balance, so there's two options here, left or right. We've got a decrease in the terms of trade. We'll start there. So a decrease in the terms of trade will be caused by a decrease in the index of export prices and or an increase in the index of import prices. So from a mathematical perspective, they're the only two things that can cause the terms of trade to deteriorate. And so if that's happening, guys, we can translate that through to export credits and import debits. And so we're saying, okay, well, if there's a decrease in the index of export prices, possibly fueled by a decrease in the demand for exports, well, we're going to see a decrease in export credits. At the same time, if it's because of an increase in the index of import prices, which means we have to pay higher prices for imports, we're probably going to see we're going to see an increase in the amount of money that's needing to be spent on imports, which is going to lead to an increase in import debits. So both those outcomes are going to decrease the current account surplus, and then the opposite is true. So if you've got an increase in the terms of trade due to an increase in the index of export prices, that funnels through to an increase in export credits, which is favourable, and or you've got a decrease in the index of import prices, which means we don't have to pay as much for imports anymore, which means we don't have to send as much money offshore. So we see a decrease in import debits. And both those things are going to contribute to an improvement in the current account surplus. So that's it. Have a think about how material living standards and non-material living standards fit into that. Make sure you funnel that through your domestic macroeconomic goals. Keep it simple. Go through obviously improved access to goods and services, and then that'll give you a nice argument that links to material living standards. Thanks, guys.